Hey, I'd like to welcome you to another episode of Mission Matters. My name is Adam Torres, and if you'd like to apply to be a guest in the show, just head on over to missionmatters.com and click on Be Our Guest to Apply. All right, so today's guest is Kim Flynn, and she's president over at XA Investments. Kim, welcome to the show.
Thank you, Adam.
All right, Kim. So excited to get into today's topic. So we're going to talk about interval fund market trends, really how financial advisors are embracing the use of alternatives. We'll also kind of define alternatives, what that means for the investors out there that maybe don't have much experience with alternatives or that market. So we'll get into that as well. But before we do, we'll start this episode the way that we start them all, with what we like to call our Mission Matters Minute. So Kim, at Mission Matters, our aim and our goal is to amplify stories for entrepreneurs, executives, and experts. That's what we do. Kim, what mission matters to you?
Sure. Our firm is focused on education around alternatives. And the reason education is so important is that the burden for saving for retirement, is on your shoulders, it's on my shoulders,
Mhm.
and access to alternatives that pension funds, endowments have historically had, we have not. And
Hmm.
so making alternative investments more available and frankly helping people understand the benefits, that's what we're really focused on here at XA.
Yeah, it's great. Love bringing mission-based individuals on here to share why they do what they do and how they're doing it, and really what we can all learn from that. So good to have you on. And just to get us kicked off here, alternatives. How did you first get introduced into that space? And for some of the audience that have been watching this a long time, I was a financial advisor. I was in the space and in finance almost 14 years before media. So I'm interested because you've made a career of alternatives. So how did that start for you?
I think, like a lot of people's careers, it's been sort of stepping stones. And then once I found a match in a mentor, it really set me on the path that I am today. But I started my career in investment banking, working at Morgan Stanley, and I didn't love it. I liked that it was fast paced, but I felt like I had more to offer, and I wanted to spend my days thinking about the capital markets. And so I found myself in asset management. I ended up working at Nuveen Investments, which is a leader in certain innovative product structures, and they're well known by a lot of individual investors. So that's where I found really terrific mentorship. And to distinguish what I was doing, I knew I wanted to be at the cutting edge and was looking forward. And now that alternative investments are really more available, that was where I wanted to spend really the next part of my career. And so I founded this business, XA Investments. And I actually happened to found the platform that I run with a couple former investment bankers from Morgan Stanley. So you never know where your career connections are going to lead you. But yes, our focus is on alternatives. And what's exciting about that is that, some of the smartest individuals in asset management, they're no longer running large mutual funds. They're at hedge funds. They're at crypto shops. They're running private equity. And so that was what was appealing for me.
What do you think's drawn people to these individuals, or even yourself? Like a lot of different routes you could have went. Like, what made you stick with alternatives? Like, what was so interesting about it?
Well, I think it's the challenge of, on the face of it, do you really understand what private credit is or what private equity is? So you have to dig a little bit deeper. Once you do, you understand that private equity is simply companies in the U.S. that are not traded on an exchange; they're privately held. And so I think that once you dig under the surface of alternatives, while seemingly complicated, I think there's ways that we can relate and understand these businesses. And so that was what was compelling. I felt like it was sort of foreign. And once I familiarized myself with the return potential, the diversification potential, that was what encouraged me to learn more.
Talk a little bit about your process and just the process of how you go about looking for and sifting the private markets for these investments. Like, what does that look like?
Well, Adam, I think let me give you an example because we've spent the last 2 years working with firms on real asset type products. And real asset products are things that provide inflation protection. And as we all know, when we go to the grocery store or we go to Target, inflation is top of mind. And
Yeah.
so you want an investment that can help you and is going to return more in an environment where we're seeing inflationary pressures. So an example would be infrastructure. Another
Mhm.
example might be farmland. And I've spent the last couple of years helping asset managers um, take what they do for institutional investors
Mhm.
and bring it to individual investors. And farmland and infrastructure, these are tangible assets. People, you see a photo of a beautiful piece of farmland. I
Mhm.
think it creates some of that familiarity and understanding that helps people as they approach investing in
Mm.
alternatives. So real assets has been a really hot area in the last couple of years, and I think has brought a lot of people
Mm.
from stock and bond investing to consider some of these other types of investments.
Hmm. Why do I mean that's a good point. Why do people like just the individual investor? What are some reasons? And obviously, it's going to vary from person to person. And if somebody wants individual investment advice, they should talk to their financial advisor or their asset manager. I mean, that's a given.
Right.
But what are some of the general reasons that people seek out alternatives? Just the investor on the investor side of things.
Yes. So, what an investor is looking for in an investment that's not a stock or not a bond,
Hmm.
it's sort of a catch all description of assets that are going to be moving in a different direction than the
Yeah.
stock market. So, the diversification is you might generate a positive return when
Hmm.
your equity portfolio is down or off for the period. And
Yeah.
so, we're also looking for things that aren't moving with capital markets. So
Hmm.
an example of this might be catastrophe bonds,
Mm.
or which depend on weather risk, or
Hmm.
insurance-linked securities, or litigation finance. They
Mm.
they all capture returns from different sources of risks,
Yeah.
and that's helpful because so many U.S. investors are overweight large cap U.S. equities. We talk a lot about stocks like Nvidia, and it just underscores the notion that people are sort of heavy in a couple of names, and that's why this diversification is important.
Hmm. And I like the fact that you named a couple of these. Like let's just I'm just going to pick one randomly. Litigation finance.
Sure.
So for if I when I used to get in when I was managing assets, one of the things that I used to kind of bring to investors' attentions that a mutual fund, a ETF, like once upon a time was a drip plan. Once upon a time, I mean, these are all products. These
Right.
are all products that are marketed to the industry and that are marketed through either financial advisors, asset managers, web platforms, just depending. But these are products that you're purchasing as an investor or you're investing as an investor, right? But you're buying into that type of product. Once upon a time, mutual funds, somebody would have thought that a mutual fund, well, I'm not purchasing a mutual fund. I need to have direct ownership right into that individual stock and all these other things. And then the market evolved over time. And as it evolved over time, it became more acceptable to invest in. And now,
Mhm.
obviously, mutual funds are a way that many, many people get exposure to the stock market. But now juxtapose that kind of concept with maybe litigation finance. Because someone hasn't heard of it doesn't mean, or because somebody doesn't know exactly how it works, it's just not, and it hasn't been marketed maybe to the mainstream as
Right.
much as some of these other products that I mentioned before, doesn't mean that it's not something that should be considered in a portfolio and that can complement a portfolio. And in your case, you're talking about for example, the correlation of just saying, okay, well, if your stocks are going one way, you want something else maybe to hedge that possibly or to complement the overall portfolio. Um,
Yeah.
talk a little bit about that, like, and from your experience, because from my end, I'm looking from the investor side, but from your end, I know you're also working with managers, so I know maybe even some managers haven't really considered how that would work into their clients' portfolios because it's a different conversation when you start bringing in alternatives. So maybe talk a
Yeah.
little bit about that from your standpoint.
Yeah. And when you're talking about alternatives, we're speaking largely about actively managed funds, actively
Hmm.
managed strategies. In the case of litigation finance, this is an actively managed
Yeah.
pool of receivables. Think about a court case or settlements that you read about in the news, or if you've ever been personally involved in a court case. Some
Hmm.
of these court cases can go on for years and years and years. And
Yeah.
so part of what litigation finance is doing is there's financing some of these multi-year cases. Some of them are corporate
Hmm.
litigation settlement type cases with big multi-million dollar wins. But if
Yeah.
that comes after a 5-year period, um, you need to pool the risk associated with different court cases, different forms of litigation. And so that's what an active manager is going to do. And the interesting thing about it is because, this is an entirely different type of risk that's
Yeah.
diversifying to your portfolio, and it does produce some income, because there's income characteristics that are beneficial, and the nice thing about it, in a similar way as a collective farmland fund,
Hmm.
you're getting diversification from the different parts of the portfolio. So,
Hmm.
you may be uncomfortable buying a single parcel of farmland,
Hmm.
but if you're investing in an actively managed pooled vehicle, like
Hmm.
a registered fund, the benefit of diversification comes through. In farmland, you're going to get geographic diversification, you're going to get crop
Hmm.
diversification. And so that form of diversification will differ depending on if we're talking about litigation
Hmm.
finance, multiple court cases on one hand, or farmland, different types of crops that are being grown in different
Yeah.
parts of the country. But that diversification is so important, and you need an active manager who understands that area of investment and can deploy capital
Hmm.
most effectively. And so we don't encourage people to go out and do these things directly
For
unless you have
sure.
a
Yeah.
lot of innate knowledge of farming, or farming has been in your family for a long
Yeah.
time. But for us, where that's not the case, the pooled nature of it provides a lot of diversification potential as well.
Yeah, it makes so much sense. It makes so much sense when you kind of explain it all. It's like, yeah, especially on the part that, you do obviously need an active manager. I know you didn't say that, but I'm saying that, like,
Yeah.
for me, that's my words. But because I'm like, last thing I'm doing is I'm going out there like, all right, let's start getting some direct investments into these and start getting into farmland, because I have no background. I have no background in that, obviously. So I'm speaking for myself. I know one of the other things that you're doing is you're helping asset managers launch registered funds. So let's talk about that a little bit. Like, how are you doing that?
Well, I mean, the goal is for these alternative asset managers who've largely been running private funds. And private funds, aren't accessible to the individual investor.
Hmm.
But the reality is that the growth in the U.S. market is happening at the retail level. And the
Hmm.
reason for that is that, I save for my own retirement, as do you. And
Hmm.
that's where the money is accumulating, and that's where the growth is. Institutional capital pools, think of pension funds, they're all
Hmm.
shrinking. And so those are declining growth rates. And if you're running just private funds and you don't have registered funds that
Hmm.
allow retail investors in, you're going to
Yeah.
be missing out on this growth opportunity. So firms like McKinsey, they've been doing this research for years now, but it's just in the last 3 years that asset managers have woken up to this. And
Hmm.
it's not just the private equity firms or the hedge
Yeah.
funds, it's the traditional asset managers as well. I mean, these traditional asset managers, the PIMCOs, the Nuveens, the BlackRocks of the
Hmm.
world, their world has been rocked by the shift from mutual funds to ETFs,
Hmm. Oh
just
yeah.
as that business has changed so much. And so there's a lot of forces driving this move into alternatives. And I think
Hmm.
it's definitely beneficial for individual investors, giving them more choice, but it
Hmm.
also makes I think asset managers
Yeah.
now are having to learn a new business. They're having to
Hmm.
develop relationships with financial advisors where they've had none in the past.
Hmm.
So it's a whole new world for them, and it's an awakening as to really how wealth management in the U.S. is going to be going forward.
Mm. What do you think has kept them from participating? Obviously, it's going to vary from person to person or firm to firm, but what do you think's kept them from kind of joining for so long, or from kind of going in this direction for so long? Because it's been coming for a while.
It has been coming. So I think the reality is there's now sort of proof of concept. There are
Mm,
firms that have gone out there and raised very large evergreen vehicles, so
mhm,
funds that go on in perpetuity.
mhm,
So Blackstone has been a leader in creating products in the non-listed REIT, the non-listed BDC marketplace.
mhm.
Those are just vehicles that house real estate investments and
Yeah.
middle market private credit investments. But interval funds is sort of the next product structure that's become in vogue. But an
Mm,
interval fund can house anything. You can put private equity, you can put a hedge fund strategy, you could put farmland into an interval fund. And so an interval fund is more versatile in the same way that a mutual fund is versatile.
mhm.
Mutual fund can house any liquid asset class, but the interval fund is really designed for private market exposure that tends to be less liquid.
Hmm. What excites you in the alternative space in general right now? And it could be, I mean, it doesn't have to be a specific investment, but I mean like technology, trend, otherwise. And the reason I ask you this question is you've been in this space, this has been your playground for a while, so to speak. Like what excites you right now? Like what's evolving? What's new?
Well, now that the market has grown,
Hmm.
there's 230 funds, which means there's a lot of choice. But
Yeah.
what excites me is that the good stuff is available. And what I mean by the good stuff is you're talking about asset managers that have very long 20, 30-year track records,
Mm.
managing institutional money. They're finally available. They're finally here for individual investors, but in a product where I get a 1099 and I
Yeah.
don't have to deal with a K1 tax form for a private fund. So
Mm.
the fact is that we have very credible alternative asset managers that have been doing this using their same process, their same
Mm.
strategy. They're not watering it down when it
Mhm.
comes to retail investors. And that's really important because,
Mm.
there's plenty of firms that could go to market with a product, but has it been time tested, and
Yeah.
is it the good stuff? I want the same institutional strategy, and so that's what excites me.
Yeah. And so, I mean, based off that, just to make sure I'm understanding correctly, now retail investors through these types of investments will have access to maybe some investments that they could have never accessed because it was only for a pension fund or an endowment or a foundation or something else. Am I off on that or?
No, that's right. And like, think about private equity because it's
Mhm.
gotten so many headlines recently. You
Yeah.
know, companies are in the U.S. are staying private longer, and there's so much growth happening
Hmm.
when a company is private. A good example
Hmm.
is Palantir, which has been in the news recently.
Hmm.
Palantir is about to be added to the S&P 500,
Hmm.
and that company was a unicorn until it went public in September of 2020, right?
Hmm.
And it experienced massive growth in the private fund, in the private
Hmm.
stage of that company's development. And that's what Americans want to tap into is the
Yeah.
growth potential, because growth potential equals return potential. But
Hmm.
but Palantir, like a lot of other companies, waited to go public. And so private equity is what is going to allow you, or venture capital, even at an earlier phase of growth,
Hmm.
is what's going to allow you to tap into that amazing amount
Yeah.
of growth that's happening in the U.S.
Yeah, and just to elaborate on that just a little bit more, so or to make sure I understand it correctly. So what the trend has been for a while for some of these like really these companies that were doing well is they stay private longer, and the only people that are or the only individuals or foundations or otherwise organizations I should say that are benefiting from that like early growth or that mid stage growth before they're at a certain level are going to be the people that had access to the private equity or got the call or had access to the deals, where the individual investors not they're probably not going to have that type of access. So by the time it gets to the public, it's that big maybe early growth is already they're taking money off the table versus some of them are
That's right.
versus and already realize their game before it even gets to the public and them having an opportunity at getting a crack at it. Am I off on that or?
No, I mean, you hear Elon Musk speak about it regularly.
Yeah.
His companies like SpaceX and XAI are private, and I think he intends to keep it that way.
Yeah.
And so the only way that people have been able to access, there are some employee shares that
Mhm.
trade, but the truth is that there's a lot of people clamoring for that type of exposure, and there's
Mhm.
plenty of other U.S. private companies, and it's really only through private market type
Mhm.
products. And the interval fund space is one way to
Yeah.
enter those types of private markets. We've talked about private equity, but frankly, in 2024, it's all been about private credit.
Mm.
So I think what's exciting is that the future for interval funds is whatever is in vogue. A couple years ago, it was real asset products. This
Mhm.
year, it's private credit. Next year, maybe it's a hedge fund strategy. We'll see as sort of the months or the days get closer to the election. But that's a variety of strategies depending on your risk tolerances and preference are there, but that's
Mhm.
how you tap into some of this growth that and you can't put these exposures into a mutual fund or an ETF. I think that
Yeah.
needs to be said,
Mhm.
because these investments do tend to be less liquid.
Mm. It's great. Well, Kim, this has been a lot of fun. I mean, finally getting you on the show, getting into your world of alternatives, your background, how you got started, and really current trends. I mean, what's next? What's next for you? What's next for your firm?
We just continue to help advisors learn about how they can enhance their practice
Hmm.
using alternatives. And we're continuing to focus on our mission, which is making these products and strategies more available to more investors. Right now,
Hmm.
alternatives are just a really very small part of people's overall retirement plan.
Yeah.
And we have work as an industry to get there. So that's what we're focused on for
Mhm.
2025. The good thing is that we have a lot of partners. There's a lot of firms that are focused on this. So you're
Yeah.
going to be hearing more and more in the days to come about interval funds.
Amazing. And Kim, if somebody wants to, if there's an advisor or asset manager out there that wants to reach out and learn more and see how you can also help, how do they do that?
Sure. Go to xainvestments.com. We've got a knowledge bank with white papers and other research on the marketplace,
Mhm.
and always happy to have another conversation as well.
Fantastic. And for everybody watching or listening to this, just so you know, we'll put the links in the show notes so you can just click on the link and head right on over. And speaking of the audience, if this is your first time with Mission Matters and you haven't hit the subscribe or the follow button yet, we invite you to do that. This is a daily show. Each and every day, we're bringing on new guests, new ideas, and hopefully new inspiration and knowledge to help you along the way in your journey as well. So, again, hit that subscribe or follow button so you get the notification when tomorrow's episode comes out. And Kim, again, thank you so much for your work and thank you for coming on the show.
Thank you, Adam. I appreciate it.